Hi folks, and welcome to this problem, which is what I'm calling a comprehensive problem because it gets you to analyze, record, and summarize or post accounting transactions. And then we get you to prepare some of the financial statements that we talked about earlier in Chapter 1 of our course, and as well answer some theory questions related on those statements. So let's begin. We can see here we have a company, and they've given you at the start of 2014 all of its opening balances for its balance sheet accounts. Now notice here all of these accounts are balance sheet accounts. Assets are here on the left and liabilities, including unearned revenue, as well as contributed capital and retained earnings, which are your shareholders' equity accounts, are on the right. They said that in addition to these accounts, during 2014, they affected accounts that were revenue and expense related. So what they want you to do here is to analyze each transaction. So in the analysis part, we remember that we have to identify the accounts that are affected, if those account balances are increasing or decreasing, and if they keep the accounting equation in balance when we increase or decrease those accounts. Then what we're going to do is use that information from the analysis stage and prepare journal entries. We're then going to summarize the transactions that we analyzed and journalized or recorded by creating T accounts and entering those balances in the T accounts so that we can update the balances in each account, including revenues and expenses, to prepare our trial balance, our income statement, our statement of retained earnings, and our classified balance sheet. And then down here we have some theory questions that we'll get to. So let's begin. Now, you may find it useful to have the question in front of you as we're going through the solution. You can choose to print it if you wish. So now, let's go right to the solution, and you'll notice here that what I've done is I've just given you a little refresher of what we talked about in an earlier chapter, which is the accounting process, which is what we're capturing here. The accounting process involves the analysis, which is our requirement 1 of financial transactions, the recording, which is where we'll make the journal entries using the debit credit framework, and then the summarizing of those transactions, which involves posting to the T accounts to update those account balances. So if we look at the first transaction, it says that we received $50,000 in cash from customers for subscriptions that had already been earned in 2013. Well, guess what? If we had already earned that revenue in 2013, then we must have sold to the customers on account because they're paying us now the next year. So what does that mean? What accounts would be affected in our analysis? Well, we could see that our cash would be going up because we received cash, and any accounts receivable, which was money we were hoping to receive in 2013 but didn't get till 2014, would have involved creating an account receivable back in 2013. So that account receivable must be going down. So now if we just take a look at our analysis, what will we see? Our cash is going up and our accounts receivable is going down. There's no change to liabilities or shareholders' equity. So the left-hand side of the equal sign is 0 at net, and there's no change in liabilities and shareholders' equity. So that means that our accounting equation remains in balance based on our analysis. Now let's look at the next question. It says here in the second transaction, it says that we received $25,000 in cash for licensing revenue that we earned in 2014, specifically January. So we know we got cash, but we received the cash when we earn the revenue, so our revenue goes up. Don't forget, when revenue goes up, shareholders' equity goes up. When cash goes up, assets go up. So the left-hand side of the equal sign goes up 25,000, as does the right-hand side, because shareholders' equity goes up. So our equation's in balance. If you're having some challenges remembering, you might want to print the balance sheet equation information here. You might find that helpful. All right, so that you can see that when revenues go up, retained earnings goes up. When retained earnings goes up, shareholders' equity goes up. So your right sides here are all going up, and then your shareholders' equity again would go down when retained earnings goes down, and retained earnings goes down when we debit expenses. All right, so that you might want to keep that handy. All right. So now, what about our third transaction? It says here we purchased 10 new computer servers for $33,500, and we paid $10,000 cash and signed a 3-year note for the remainder owed. Well, the first thing you remember is that in our requirement, we do have to do a classified balance sheet. So we can see here, this is important because we have a 3-year note. That 3-year note is a long-term item. So how are we going to classify it? Is it an asset or a liability? Well, that's part of our analysis. So we see we bought computer servers, which is equipment. Equipment is going to go up, right? Equipment will go up by $33,500, and to get that equipment we paid cash, $10,000, so cash goes down. So at net, the left-hand side went up $22,500. So that's the amount by which the right side goes up, because we're going to be recording a long-term note payable. That note payable is a liability, so we're going to have a non-current or long-term liability in our classified balance sheet. We can see that our accounting equation is in balance. Now let's look at the next transaction. We paid $10,000 for an internet advertisement that runs on Yahoo in January 2014. So now let's go have a look at that. Well, again, we paid cash, so our assets are going down, specifically cash, and we were doing advertising. Advertising is an expense. We incurred that expense in 2014 in January, so we want to record it as an expense of that period. So when your expenses go up, that means your shareholders' equity goes down, right? So again, if you go back here, when your expenses go up, right, your shareholders' equity goes down. All right? So our accounting equation is in balance. In the next transaction, we sold 15,000 monthly subscriptions at $15 each for services provided during the month of January. Half we collected in cash and half was sold on account. So what accounts are affected? Well, if we sold part on cash, we know that cash is affected here. How much is cash affected by? Well, cash went up $112,000. We didn't collect all that money from our customers, all of the $225,000. And don't forget, we get $225 by taking $15,000 times $15. $15,000 in monthly subscriptions times $15 for each subscription. So we've earned revenue in January, we've taken in cash, and the rest the customers will pay us later. So to us, as VGC, that's an account receivable. Right? So we can see our assets go up $225,000 and our shareholders' equity goes up $225,000 because revenues go up $225,000. So our accounting equation is in balance. If we look at F, what happened? Well, we incurred some costs. In F, it says we received the electricity and gas bill for $53.50 in January, but we're going to pay the bill later. So we're creating an account payable here, which is $53.50 because we're going to pay our utilities later. But these are utilities that were incurred in the month for which we're recording revenues and expenses and doing our statements. So that is an expense of the period. So we're going to incur the expense, which increases expenses, which decreases your shareholders' equity, and we're going to increase our liability. So we've got liabilities on the right-hand side of the equal side going up and shareholders' equity going down. So the right-hand side of the equality at net is 0 and no change in the asset side, so everything is in balance. If we look at the next transaction, what happens? we incurred some salaries and wages expense, and we paid them out. So what happened? We incurred $378,000 in salaries and wages expense for work that was done. So we paid out cash, so cash is going down and our expenses are going up. Don't forget, when expenses go up, shareholders' equity goes down. So therefore, our accounting equation is in balance. In H, it says that we purchased $3,000 of supplies on account. So what happened there? Well, if you're buying on account, what does that mean? That means that you are not paying right away. So your liabilities are going up, accounts payable, and you got an asset, you got supplies. So your assets are going up on the left side, your liability is going up on the right, so your accounting equation is in balance. And the last transaction here says that we paid some of those accounts payable that we incurred, okay, when we bought those supplies in the previous transaction. So now we no longer owe the vendor or the creditor because we're paying them, so our liability is going down, and it's going down by paying out cash. So you can see the asset side's going down, as is the liability side. They're on two opposite ends of the equal sign, so assets go down, liabilities go down. The equation on the left side and the right side of the equal sign stays in balance. So we're good. The accounting equation is in balance. So now, what we're going to do in our next step is we are going to look at recording these transactions. So what would we do here? Well, the first thing we would do is, if we went back here, we could see that our asset cash was going up and our asset receivables were going down. Now might be a good time for you guys to refresh your memory on the balance sheet equation. When assets go up, it goes up on the left, and left means debit. They go down on the right, and right means credit. So if you go here, you can see your asset cash is going to go up, which is a debit, and your accounts receivable, which we identified again up here, is going down, and the asset going down is credited. So again, the total dollar value of all debits and credits in the transaction is equal. We also said in the previous transaction B that we earned licensing revenue, so our revenue goes up. And again, when revenue goes up, it goes up on the right, and right means credit. And again, we said that in our question, we also had cash going up. So when cash goes up, it goes up on the left, and left means debit. So we debit cash and credit our licensing revenue for $25,000. So now we'll go back to the next transaction that we analyzed. And don't forget, this is actually a 3-line journal entry that we're making now. And again, it says that our equipment went up and cash went down. Well, these are both assets. We had an asset going up, which is a debit, and an asset going down, which is a credit. Our liability went up, and don't forget again, when liabilities go up, they go up on the right, and right means credit. So therefore, we're going to credit our liability account, long-term notes payable, for $23,500, and you can see the total dollar value of all debits and all credits are equal. So our entry is in balance. The next transaction that we're going to look at here is item D. And in item D, it said that we incurred advertising costs and paid them out at the same time. Well, don't forget, advertising expenses for this period increased, which decreased shareholders' equity. Again, when expenses increase, they increase on the left, and left means debit, but they also decrease shareholders' equity. So therefore, we are going to decrease our shareholders' equity by $10,000 when we increase the advertising expense. We've decreased cash $10,000, so we credit it. So the total dollar value of all the debits and the credits that we processed in this transaction are in fact equal. If we now go down to the next set of transactions, what do we see? We see here that for our next transaction, We received some cash when we sold $225,000 in subscription revenue. So we said earlier that our revenue was going up. That was back here. Revenue went up, and when revenue goes up, our shareholders' equity goes up. We also said that we were receiving cash for half of it, and we know that we were receiving the rest from our customers later. So that means we're going to increase two assets and credit our revenue account. And again, don't forget, all debits go in first, and then your credits go in second. Debits align to the left, and credits align to the right. We incurred utilities during the month of January, and we were going to pay them in February. So when our expenses are going up for January, it decreases our shareholders' equity. And we said that when expenses go up, we debit. So therefore, we debit our expenses and credit our obligation or liability to pay later. So we increase our liabilities, $53.50. We said that we had salaries and wage expense for the month of January of $378,000. So again, our expenses go up, which decreases shareholders' equity, and we're going to credit cash because cash is an asset. And when it goes down on the right, and right means credit. All right. So now, the last two entries here, we bought supplies. That's an asset, but we didn't pay right away. So we created an account payable. So our liability is increasing. It does so on the right, and right means credit. And we're going to debit our assets. Our assets have gone up. They go up on the left, and left means debit. The last transaction we have here to record using the debit and credit framework is the fact that some of those supplies that we bought, we now paid the bill. So we paid the bill, we reduced our liability, and we reduced our asset cash. So we debit the liability because when we reduce a liability, liabilities reduce on the left, and left means debit, and we were using cash to reduce the liability, So we reduce assets on the right, and right means credit. So therefore, we are going to credit cash, debit AP, and you can see the total dollar of all the debits and the credits we processed are equal. In the next video, we're going to quickly review the third step in the accounting process, which is summarizing the transactions, and then we will get into preparing our statements and then as well our trial balance. So stay tuned.